Have you started your journey in stock market with failures? Are you continuing failures or have you improved from it? Are you a successful trader but just want to relook at what made you different? Then this episode is for you. Welcome to the fourth episode of Investing Sense. This episode contains wisdom shared by a successful trader named Micheal Marcus who transformed $30,000 to $80 million in less than 20 years. This episode is taken from a book named Market Wizards written by Jack D Schwager. Jack D Schwager had to face many investment failures throughout his life and set on a mission to find out from successful traders on how they succeeded. First interview of Jack Schwager in this book is with Micheal Marcus. After going through his interview, I have organized his thoughts into 4 aspects and you can use it as a checklist. The 4 aspects are what to invest, how to invest, when to exit the market, and fourth one, characteristics of a good trader. Let me give a brief about Micheal Marcus so that you can appreciate his efforts. Micheal Marcus graduated from Johns Hopkins University near the top of his class. He had a PhD fellowship and fully expected to live the life of a professor. Through a mutual friend, he met a guy named John who claimed that he could double money every 2 weeks, like clockwork. It was so appealing idea to Micheal that he didn't even think about asking John how he could do it. He didn't want to spoil things by finding out too many things. He hired John as his commodity trading advisor at $30 a week. He allotted $1,000 for trading from his savings. He went to brokerage house with John. Micheal quickly realized that John doesn't know anything about trading and he was trapped. Within 3 days, he lost his entire $1,000. He fired John. He was never disappointed with his failures. As he considered himself a good student, he figured out that trading was just a question of getting the knack of it. He realized that he needed to learn things before trading again. He read books on commodities and subscribed to market letters. Michael's father has died when he was 15 and has left $3,000 in life insurance. He decided to use that money for trading in spite of his mother's objection. He followed one recommendation in the market letter he subscribed and it worked. He made his first exciting win. He felt he was beginning to develop a sense for trading. He liked the feeling of doing things on his own way. He traded again and again, partly based on the recommendations in the letter and partly on his intuition. He has accumulated $30,000 in that summer, which was a decent amount for a middle-class family. In this way, there are so many accounts of his trading journey in this book. You can read it if you are interested. I found his experience syncing with my own investment journey and would like to organize the wisdoms he had shared in his interview. First one, how to invest. Firstly, about ticket size. Always bet less than 5% in any idea. Why? You can make wrong decisions about 20 times and it will take you a long time to lose the money. You have to be cautious that this 5% should always be invested in one idea only. 2 different but related ideas still count as one only. Secondly, about using stops. Whenever you are making any investment decision, there is a chance that the idea can go wrong even though you have invested in it with full faith and confidence. At the beginning of trading itself, you should decide on where you are going to get out of this trade if things are not working in your favor. It helps you to save a part of the capital you have invested. Micheal shares his personal experience where he had seen many brilliant investors who made more money much faster than him, but they all winded up giving everything because when they started losing, they couldn't stop. Moving to third aspect, which is about tracking equity daily. You always have to listen to the trend of the market and re-evaluate your positions. If you are losing money at a much faster rate than you made it, then it is a warning signal. You should sit and think about your future actions and take actions based upon your analysis. Moving to second aspect, where to invest. In the previous 3 episodes of Investing Sense, we discussed about companies with high profit margin and earning potential. Similarly, Micheal Marcus advises to enter in trades looking at earning potential and market share growth. Earning per share is a parameter he uses in conjunction with market share potential. He is not interested in companies with high earning per share in a saturated market. He likes companies where earning per share is growing and there is plenty of opportunities for growth. Like any rational investor, he checks for price to earning ratio as it indicates how much the market is paying for that earnings growth. Companies with high earning potential and low price to earning ratio are the most attractive propositions. He scrutinizes the basic industry for growth as well as supply and demand mismatches. He takes advantages of commodities in cyclical pattern by entering at loss and exiting at highs. While investing in any trade, he do fundamental analysis, look for technical and market tone. Fundamentals should suggest if there is any imbalance of supply and demand which could result in a major move. Chart should move in a direction that fundamentals suggest, and when the news comes out, the market should react in a way that reflect the right psychological tone. In a bullish market, will not give much importance to negative news and react very positively to favorable news, and vice versa. If you can restrict your activities to this type of trades, you will make money in any market under any circumstances. Micheal advises against making a lot of trades when the above 3 conditions are only marginally in favor of trade idea. It is more like an adventure rather than trading success. The third aspect is about when to exit the market. During my initial discussions, I have explained that Micheal decides the stops at the time of making investment decision itself to protect the capital. There can be a lot of times in the market when you can be unsure about your trading positions and don't know what to do next. When in doubt, get out and get a good night's sleep. Things will become clearer the next day. You can always get in later. Micheal shares that he was not embarrassed to change his mind and get out of a position as soon as he invested in it. There are days when he came back and invested again in the same idea next day. An important rule Micheal follows is to hold on to winners and cut losses. If you don't stay with your winners, you are not going to be able to pay for the losses. Letting winners ride is as important as cutting losses short. The fourth aspect is about characteristics of a good trader. Micheal Marcus attributes his success to his ability of being open-minded. He is willing to take any information that is difficult to accept emotionally, but which he recognizes true. According to him, a good trader can't be rigid. He is someone who is really open to seeing anything. Gut feeling is very important. Micheal don't know of any great professional trader who doesn't have it. Being a successful trader also takes courage, the courage to try, the courage to fail, the courage to succeed, the courage to keep on going when going gets tough. You have to follow your own light. Micheal had so many friends who are talented traders. He often had to remind himself that if he tried to trade in their way or on their ideas, he is going to lose. Every trader has strengths and weakness. When you try to incorporate someone else's style, you often wind up with the worst of both styles. As long as you stick to your own style, you get the good and bad in your own approach. When he talked to other traders, he tried to take their information without getting overly influenced by their opinion. According to Micheal, the leading cause of financial disablement is the belief that you can rely on expert to help you. It might if you know the right expert. Typically, however, these so-called experts are not traders. Your average broker couldn't be a trader in a million years. More money is lost listening to brokers than any other way. Trading requires an intense personal involvement. You have to do your own homework. Whenever he gets an idea from somewhere, he analyzes how many people are left to act on this particular idea, whether markets have discounted this idea. Finally, on a personal front, he advises to keep a balanced life and to have fun outside of trading. You can't sustain it if you don't have some other focus. Eventually, you will wind up over trading or getting excessively disturbed about temporary failures. So, I hope you had an interesting session. Take the help of your financial advisors before making any investment decisions. Thank you.